Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey Fleck here, your host for this weekend's edition. What we're going to do is focus a lot on some of the market moves. In the first two segments, we're going to talk about the volatility in a lot of the commodities sectors. There are at least a couple of the key ones that a lot of our listeners follow. Also talk about some of the markets and the more concentration of moves that we have seen. And then in the back half of the show, move into the energy sector. Just as a reminder, please go back through our website, podcast, and YouTube channel to listen to all our daily editorials and company updates that we publish throughout the week. I know it feels like we're almost in a summer market here with markets slowing and some volume declining, but hey, there's still a lot to talk about, especially on the company front. Let's get this show underway as I am kicking off the show with Dana Lyons, fund manager and editor of the Lyons Share Pro website, which I will share a link to within the show notes. Dana, as we've talked throughout the last well over a year now, is that seems like there's a lot of opportunities in these markets, and just recently some of the commodities have gotten moving, but then also been extremely volatile. I want to start off with silver here, where silver made a pretty important break above $30 an ounce. That break happened in mid-May. And ever since then, boy, oh boy, it's been volatile. You look at just day-to-day price action, silver's moving sometimes over $1 a day, which is multiple percent, 3, 4, even 5% on a day-to-day basis. But in the last few weeks, it hasn't really gone anywhere. So Dana, let's dive into the silver chart. What are you seeing in terms of this volatility?
Yeah, thanks, Corey. I think it's tracking exactly along the themes, the message we talked about last time I was on, which is the substantial rally we saw in the precious metals complex up into those May peaks, just increased the implied volatility in this market, in that complex. So that just means expect more volatility, expect bigger swings, expect wider ranges from an absolute standpoint. But if you zoom out, given the extent and the significance of the rally we did see preceding, most of these large moves, what seems like a large move on a daily basis or over the last couple of weeks, it comes down to really just a mere retracement of the rally that we saw, either off of the early year lows or the lows from a couple of years ago. We're just seeing basically a third, maybe if you're talking about silver, maybe 33% retracement from the lows in February. So it's nothing to get, as far as we're concerned, nothing to get too worked up about yet. If you zoom out, that breakout that you mentioned was key. We're now seeing higher highs, higher lows across the board in the precious metals complex, whether it's the metals or the miners themselves. So from a kind of a 30,000 foot standpoint, we're seeing higher highs and higher lows, which obviously equates to an uptrend. So I'm not too concerned about the pullbacks or even the extent of the pullbacks right now, again, because they pretty much just equate to insignificant levels of retracements of the prior rally. So if we saw the entire rally retrace, for example, maybe I'd be a little bit more concerned. But at this point, especially given, like you mentioned, the several years worth of prior peaks that we did break above, whether it's silver or gold or copper, that's a substantial breakout. Until that breakout level given up, then we got to assume that the trend is up, and we'll be looking for areas or levels to buy.
Okay, so overall, still very constructive on silver. What would a level, if it dropped to on the downside, then change that outlook? What would make you concerned if it were to move down lower?
Well, we trade the SLV, the CF. I'd love for SLV to hold the 25 level, which was pretty key going back about 4 years. But even down, it's trading right now around 28. Even if it dropped down to 22, 23, it doesn't negate the uptrend. It obviously, as someone with a long position in the metals and the miners, It's always a sign of a stronger bull market when it doesn't retrace that much and finds buyers at a higher level. But as far as our view goes, from a longer term perspective, we're still very bullish on the complex, and it would take quite a bit of deterioration for us to change that overall long-term thesis. Doesn't mean right now we're in kind of a consolidation period after the huge rally. Doesn't mean that we don't trade the range right now while we're consolidating. We'll add a little bit in a pullback and try to lock in some gains into a bounce on a more micro level. But we'll hold a more substantial allocation to precious metals until the uptrend is negated. And like I mentioned, it's got a ways to go to the downside for that to happen.
So, Dan, I find it very interesting to talk about the metals with you because you're very much a generalist. So you're not all in to any sector. But that being said, you're also not going to stick out any sector if it's not performing for you. In terms of something like silver, even precious metals, what would it take for you to allocate more money towards the complex?
Yeah. So as you mentioned, we're not beholden to anything except for objectivity and quantitative data. Whatever the data is doing is what dictates our investment moves. So we could have the best thesis in the world on what fundamentally should happen, and it doesn't mean it's going to happen, or it might happen, but maybe 10 years down the road, which does us no good. It does our clients no good. So we're going to stick with the data and what the charts are doing. So that's what basically our game plan has been and will continue to be. If we're wrong, which happens, then we're not afraid to change course. So right now, we're still, like I mentioned, the metals and the miners right now are in uptrends, and we'll look to continue to get longer in those areas into pullbacks. You asked what would take to get more aggressive, and it's just better entry points. We're still in an uptrend. What we like to do is concentrate our portfolio, our money in those areas of the market that are working best, but we like to do it into pullbacks, into good risk reward entry points. So the rally that we saw into May in the metals and the miners, we're not buying into that. We might be taking some profits into that. We'll wait for a retracement like we're seeing now in order to recommit some more capital. So we'll get aggressive, but usually into weakness, and are always into areas of the market that are in uptrends and hopefully showing relative strength.
To quickly look at the SIL chart, the Global X Silver Miners ETF. Now, I know this isn't just silver miners. There's a lot of gold companies in there, big mix of companies, but it's one of the larger silver mining equity ETFs. What are you seeing in this chart? Also volatile, also nicely off of its lows, but also a long way to go to some of those highs from back in 2020 and 2021. What's this chart showing you? Also considering volume has really picked up in the last couple months.
Yeah, the volume has been great on the moves off of the lows, which is good to see. I think we talked about one of the recent shows that generally you see higher volume. More so on down moves, you see higher volume because it's more emotional than the up moves. Typically, you see volume spike on up moves when you're near the peak after a drawn-out long-term bull market, like you might be seeing here in technology or semiconductors, that type of thing that's been rallying for a while. And now you have all the Johnny-come-latelys into the party. So that's more of topping type of a volume signal. As far as the precious metals, which saw a lot of volume right off the lows into the rally, that's more of a bullish sign. That's more of an ignition type signal or escape velocity type signal where you get that high volume just at the beginning of a move. So to us, that's certainly a bullish sign. And SIL, whether it's SIL or the junior silver miners, very similar to silver itself. It's been going sideways. The miners really in a downtrend more so than even silver over the last 4 years or so. But in that recent rally since the beginning of the year, did finally hit some higher highs, which is the first time in a while there. So broke kind of that downtrend, consolidating that rally right now. We'll look for it to kind of flush some people out here, but very much still in an uptrend, very much still in the posture where we want to be buying dips and ahead of what should be the next leg higher in this possibly very early on uptrend.
Okay, how about copper then? Because boy, oh boy, copper went on quite the run throughout the first half of May when it broke over $5 and then almost immediately reversed back down. And as good as May was looking for copper, it pretty much ended the month flat and has had a little bit of a downward bias since. But to kind of some of your points earlier, a key breakout above $5 last month. What do you see in the copper chart?
Yeah, again, very similar to silver. I think historically you could look at silver as kind of a higher beta play on gold. And then just recently, especially, copper has been really a higher beta play on silver. So going in the same direction, just experiencing a little bit more volatility or a little higher beta in copper than silver, but very similar charts. Copper actually over the last couple of years has held up a little bit better than silver, but experienced a similar breakout over the last couple months. Now pulling back. It's been a rough month or a couple weeks, obviously, for copper. It's really gotten hammered. But again, considering the extent of the rally we saw off of either the early year lows or the lows from last fall, last October. So we're seeing like maybe a 33 to 50% retracement on there and probably coming into an area which is very attractive to us in terms of adding further exposure to it.
Okay, Dana, let's now move over to the markets and really address the elephant in the room here being NVIDIA. Over a $3 trillion market cap, worth more than Microsoft. A lot of the bears want to point to the lack of breadth here, more the concentration of just a few stocks leading these markets higher, which in all fairness, we have seen a few times over the last couple years. What are your comments to all the bears out there that say there's no breadth or there's a lack of breadth and NVIDIA, it's gotten too hot, this is dangerous?
Yeah, well, speaking to NVIDIA and the semiconductor space, these types of blow-offs or bubbles, if you want to call them, they're going to cost a lot of people a lot of money, probably most of their money that they put into it at this point. With that being said, bubbles are great until they pop. So we're long semiconductors. We'll continue to be long semiconductors until the bubble does pop or the data suggests we get out. That doesn't mean we don't manage risk along the way. So in something like SMH, for example, a semiconductor ETF getting close to a key Fibonacci extension level around 282, we'll take some profits there and we'll continue to take some profits along the way. We don't have to capture every last drop of the rally. It's just like if you're going to be buying the dips, you have to book some into key levels on the upside, key extension levels. So that would be one area in SMH. NVIDIA obviously is a huge part of that ETF and a huge part of the major averages, the S&P, the NASDAQ 100. So obviously as that goes, it's going to have a huge influence on what those major averages does. So we'll keep a close eye on that. We don't typically track individual stocks as much, but considering the extent of the composition of those averages that it holds, then it's obviously, it pays to keep close attention to it. So we, like you mentioned, we've seen periods in the past where we've seen a very small concentration of top stocks, or maybe I should say a high concentration of indices in very few stocks. We saw that at the dot-com bubble. We saw it to some extent back in 2007. I've certainly seen it now. So that is a sign of participation or declining breadth or internals in the market, which is not ideal. Again, it can last for a long time. The divergence in breadth back in 98, we saw the major market, overall market pop in 98, and then the averages continued to last, or the rally, the major averages continued to go till 2000. So it doesn't typically last that long, but it can. As far as a divergence now, we've seen confirmations for the most part in breadth to all the S&P 500 highs until just this month. Even in May, we saw those highs, those new highs confirmed by breast stats like the NYSE advanced decline line. We're not seeing that now in this latest pop to new highs, which certainly for us is a concern. Also seeing an expansion in new lows versus new highs, even as the major averages hit all-time highs. That is a major concern now. So probably the last time we talked, or maybe a couple times ago, we were not that concerned. We're starting to see more and more troubling signs from a breadth perspective pop up. So it doesn't mean you jump all out, doesn't mean you get aggressively short, but it is a kind of a leading indicator, a heads up, an early warning sign that this rally in things like NVIDIA or the major large cap averages, once those do give way, there's not that foundation underneath as in terms of a strong internal, strong level of participation, the broader market that can prop it up. So again, not every data point is a signal, and eventually will be. The timing is sometimes tricky, but we are seeing more warning signs now than we had in those earlier rallies this year, the ones into March, April, and then the new highs in May, which were confirmed. We're not seeing that confirmation now. So it's definitely got our antennas up.
Okay. Hey, fair enough. Look, the S&P has been up, I think, 8 out of the last 9 weeks, if you include this last week. So, yeah, some sort of a pullback. But that lack of breadth, again, as you said, that's a bit concerning now. And that means a lot coming from you and your models. Where are some sectors out there that you still see strength in? We already talked about the commodities. Commodities were doing well. But any other pockets of markets that your models are constructive on?
Obviously technology, but we've covered that. That's very extended. It's hard to jump into it here. We'll ride it out with the positions that we have because they're still, from a chart perspective, still very constructive. Industrials and financials trying to hang in there. Energy is, if you're looking for something to buy now that's not extended but still in a nice uptrend, energy is giving you an opportunity right now. But maybe a theme that has been emerging of late is kind of the defensive sectors that have really improved over this quarter, whether it's healthcare, utilities, consumer staples, which have really done an about face in terms of relative strength. They were really beaten down and not keeping up with the market. It's been a reversal over this quarter. They have seen some money rotate into them and consolidating right now, but overall look poised to continue to the upside, which if some of the more risk-on sectors continue to fall by the wayside and these defensive sectors continue higher again, that's not a sign to jump ship, but it is another one of those early warning signs of a major top, kind of like some of these early breadth divergences. So it's something to keep an eye on, and another sign of maybe a late stage rally that we'll continue to monitor. But as long as they hold up, if you're looking for a spot to allocate some equity money to, some of those defensive sectors are starting to behave a little bit better and certainly are not too extended.
All right, Dana, thank you so much, as always, for talking about some of these markets. We didn't go to so many markets this time because I really did want to spend more time on some of the individual charts, especially in the commodities, to make sense of some of this recent volatility, which sounds like you're still very encouraged on a number of the commodity sectors, and something to watch out for these markets. A correction should be coming, could be coming. We'll see how far these markets drop and what kind of buying opportunity it lends itself to. Dana, thank you, as always, for your time. Again, Dana is the editor of the Lyons Share Pro website, which I will share a link to in the show notes. Dana, have a great rest of your weekend.
Thanks, Corey. You do the same.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we're now focusing on the energy sector as I'm chatting again with Josef Schachter, founder and editor of the Schachter Energy Report. Josef also writes the Ion Energy Report, which is a free product covering the data around the oil and natural gas prices, where Josef looks into some of the storage figures, the inventory numbers, production numbers, more on a broad sense. The Schachter Energy Report, that's where he dives into a lot of the energy companies and shares his thoughts on which ones are the best opportunities. Something we'll get into in the second segment here. Josef, as we usually do when we start these calls, is provide an update on some of the data that is in either oil or natural gas. But I want to start even with a broader topic here where oil has been relatively range-bound throughout this year. Started this year in the low 70s, ran up to about $87 and change in early April, and then corrected into the low 70s again, and right now is right around $80 a barrel. What is moving price in your eyes? Is it data? Is it OPEC? Is it something else? Is it economic numbers where we can actually look to something here and say, look, this potentially, whether it's data or OPEC or something else, could be the driver of a new trend, a breakout, either up or down for the oil price?
It's good to be with you again, Corey. The price of crude oil has moved around in April when there was concern about Iran and Israel going toe-to-toe. Hezbollah was attacking more. So the war premium expanded for about $10 from 77 in mid-March to 87.67, so just short of 88 in the middle of April, when Iran did not escalate after the initial firing of the drones and missiles that were knocked down by Israel and the United States and Britain and Jordan, which was interesting. The price of crude backed off to 72.48 in early June. And that was the decline because of rising U.S. inventories and weak China demand. So the issue then became of a tug of war between the war premium and the war concern, which would mean supply disruptions potentially, and the issue of day-to-day supply and demand, where the United States and China are showing weakness. And the United States consumes about 21 million barrels a day, China about 15 million barrels. So between the two of them, 36 million out of the 102 million barrels a day. And the U.S. consumption year to date is only up 0.2% from a year ago, but gasoline demand is down 1.4% from a year ago. And the reason is budgetary squeeze. So families are seeing their rent increase or their mortgage costs are going up, their insurance costs are going up, food costs are going up, doing things with their kids during the summer is going up. So the issue of a strong summer price increase because of greater utilization is where the bulls are. And that's why we rallied from 72.48 to about $82. I think that's gone too far. And I think that the data that we see in the next few weeks related to consumption, if we do not see that consumption pick up that the bulls are looking for, then we will retreat below 80. And I think we retreat even below the 72.48 that we saw in June, unless there's some spark on the war front, i.e. Israel and Lebanon go at it because of Hezbollah backed by Iran. If there's a war premium issue, then the weaker price does not occur. On the other hand, if things are quiet and Iran kind of says to Lebanon, don't do it yet for whatever reason, then the fundamentals of supply and demand will be the controllers of price. And we could see a peak below that 72.48, maybe even below US 70 a barrel. And to me, that would probably mean a very significant buying opportunity in the sector. When we were up there at 308, when there was concern about Iran on the S&P TSX Energy Index, we're now sitting around 277. And the bullish percentage index when we were at the high was at 91%, the S&P energy sector bullish percentage. So very lofty, just like we're seeing with the AI world now, where the bullish consensus is unbelievable and probably excessive. We have fallen to 45.45% bullishness today. And I believe we're going to get below 10% bullishness if we back off some more on the price of crude. And that would then give us our next buying opportunity. So the three things I'm looking for to say it's a strong buy, it's a cheap window, it's bargains again, is one, the price of crude below 70, WTI below 70. Second, the bullish percentage index below 10%. And third, the S&P TSX energy index below 240. So if we get one of those, we'll be bullish. If we get two or three, then we're going to be extremely bullish, and we'll be adding quite a few more names to our SCR buy list.
So let's say the price does drop down there. That would be, again, potentially a breakdown below the $72 level from earlier, just about a month ago. But Joseph, we're well off of highs from 2022 and even 2023 when oil reached $95. Outside of escalating war tensions or maybe just a booming economy, which not a whole lot of people are predicting, have we seen some of the highs in oil? Are the mid-90s in terms of prices kind of off the table right now?
No, I think that the issue still remains. Do we want to make progress on the climate? Do we want to have more renewables? Do we want to have more EVs? Which means more electricity, and how do you generate it? Not from coal, probably natural gas and small nuclear plants, and of course, solar panels, wind, all the things that people are working on. My view is that in 2025, we will be moving north of $90 on a consistent basis because the emerging world will show significant demand in crude to bring on more copper, more nickel, more lithium, all the things that we're going to need for the transition phase. And that means they're going to want a better quality of life. They're going to want to be able to drive cars. They're going to want electricity in their homes. They're going to want water in their homes. And so that's going to require a lot of infrastructure and usage of fossil fuels. So right now, the demand for 2024 is between 102 and 103 million barrels. Some are using 104 like OPEC, which I think they're way too optimistic based on what we know from China and the U.S. I think it's 102 in terms of millions of barrels a day on average for the year. During winter and summer, it could be 104. And then during the shoulder seasons, 98 million barrels to get to that 102 average. But I think that heading into the second half of 2025, we may even peak above $100 a barrel. And before this cycle is over, because of underinvestment in fossil fuels, be it oil, be it natural gas, and because of decline rates in the basins, especially the prolific Permian and the Montney and liquids-rich Montney and conventional oil is very high, 25, 35%. Some new wells in the Permian even are 60% decline rates, high quick payback, but you got to keep on drilling. It's a treadmill. So I think that heading into the end of the decade, we may see all-time highs above the 148 that we saw in summer of 2008. So I'm very bullish long-term. It's just the seasonality, inventory builds, near-term weakness in the U.S. economy and China economy that has me to be near-term cautious, but long-term extremely bullish.
Can supply side of the equation, can the U.S., can the OPEC plus countries fulfill some of this demand in the near term if we do see some of those demand spikes like you're predicting?
Yeah, the U.S., the Permian and the Eagle Ford still have growth potential for oil. And then you've got the natural gas basins, Appalachia and others that can bring on more, the Haynesville. And in Canada, of course, the Montney, we have a big upside as we bring on more LNG plants on the west coast of Canada. LNG Canada starts up in early 2025, so 2.1 BCF moving west that now is going south and east on a 17 BCF base. So that's a nice growth rate, 2.1 on 17. So that's going to be positive. And then if other plants get approved, Pembina is moving forward with Cedar and the First Nations. Enbridge has a project. There's Rockies LNG that's with the producers and First Nations. So there's a lot of upside, potentially 6 to 8 BCF of export capacity on the West Coast before the end of this decade on that 17 BCF base, that's very bullish for the natural gas sector longer term, even though right now there's a glut of natural gas and the price for AECO is under $1, which is horrible. And nobody can make money unless they hedge. And the U.S. natural gas is $2.80, and we need to see $3.50 there for the industry to want to spend more money.
Is natural gas going to $3.50? Because it's been a very nice run over the last couple months when natural gas was really stuck under $2. Now it's right around that $3 level. A nice move, but again, you go back in 2023 and it was around that level, if not higher many times, and well off of its highs from 2022. Is this run in natural gas sustainable?
The U.S. side is sustainable because there are plants that are under LNG plants that are under maintenance. They're going to start up again. There's new plants coming on before the end of the year. So there will be more exports of LNG by the end of the year. That will require inventory that might go into storage to go to the LNG plants and then be exported. So the U.S. is separate from Canada because the demand is more near term and storage levels week to week are not filling up as much as they were because of that demand increase on the export side. That over time will create a better environment for U.S. natural gas. Canadian natural gas, as I said, is sub $1. I think it was 85 cents an MCF Canadian, which is a horrible price. And we really need to get into Q4 when the coastal gas pipeline starts taking gas to fill and pressure test and then move that gas to the LNG Canada facility on the coast. And then they'll be doing all the testing and liquefying and all the stuff they need to build the inventory for the first shipments when they start up in 2025.
So many of the bulls for natural gas are pointing to these LNG plants, especially the new ones coming online. Joseph, how much could these raise price? Are some of these bullish outlooks too bullish in your eyes, or truly are these LNG plants going to change the pricing mechanism and lift natural gas prices sustainably?
Well, the industry needs a minimum of $2.50 Canadian to justify increasing gas drilling for dry gas. So you'd really need $3 Canadian. And if your cost is $1.25 to $1.50, that's a nice margin. If you have $2 costs, you really need $3. So the industry needs to have higher prices to get back to drilling to bring on more natural gas for these projects. If they need 6 to 8 BCF by the end of the decade, you got to incentivize them with price. So I'm optimistic for the long term. I think in 2025, we'll probably be looking at $2.50, $3 for Canadian AECO once LNG Canada takes gas. And I think later in the decade, we'll see $4 to $6, depending upon how tight conditions are, weather-related, et cetera. So I'm optimistic on the Canadian natural gas stocks. And you and I have talked about many of them over time. Some of them have been backing off here because of the market back off. As we said, we were at 308 on the index. Today, we're 277. And I think the index goes below 240. So we're seeing a little bit of a pullback in natural gas stocks. For example, Tourmaline today is down at over $1 at 1.9%. And you've got others that are natural gas producers that are weakening as well because of the issue of natural gas pricing. If you're not properly hedged, and you're seeing lower prices.
Let's talk about the stocks then, because look, these prices are not bad, especially on the oil side for the oil companies. Natural gas, hey, at least they're off their lows up in that $3 range in the US. But the energy stocks, well, they were on a pretty decent run up until April, really have just been matching the moves, at least when you're looking at XLE, of the oil price, up about 20% from when it started the year, and now down about 10% from the highs in April. What are you seeing in the energy stocks? Any areas, any pockets that are vastly undervalued in your eyes?
Well, if I'm right that we do see the price of crude back off and go below 70, the oily names probably have more downside than the natural gas, because the Canadian natural gas price, where it is right now, is already beaten the stocks up. So if the oil stocks go down, they'll drag the natural gas stocks down. But if you have a chance to buy any of the high quality natural gas names, Tourmaline, Paramount, the Crew Energy, New Vista, Pine Cliff. We can go through more and more names that are trading cheap now but could get cheaper. I would be looking at that. Stocks that are cheap right now are the energy service stocks, especially the frackers. So STEP and Trican in my book are very cheap here. And on any weakness, you want to be a buyer. So I think we're getting ready in sometime in the next month or two. If we have this fulfill the targets that I'm talking, we're going to have one of the great buying opportunities. If you go back, the last great buying opportunity was in February of this year. And we got down at the time to 231 on the index before the rally to 308. If we come down below 240, that would be the next great buying opportunity since, as I said, early February of 2024.
Okay, so let's say, again, the oil price does pull back. You're looking at buying opportunities for companies. Do you stick with the big boys or do you filter down the food chain?
Most of these companies that are in the middle and the smaller size are trading around PDP, so proved, developed, producing reserves. So you also have 1P proven, which include the non-producing proven reserves, and then you have 2P, which is probable reserves. At the top of the market, companies trade at their 2P NAV. So going from PDP to 2P could be a 3 to 5 bagger over the cycle. That's why we're bullish on oil and natural gas, because we see significant upside between now and the end of the decade. And that's why we cover 38 companies. We cover some that are kind of more conservative, the pipeline infrastructure royalty, which are for older, people who need more income, focused on income rather than growth. And then we cover a lot of the E&P and service names that have the growth and exploration opportunities to grow significantly. And many of the companies in the natural gas side, knowing these LNG plants are coming on, have growth plans to bring on more pipelines, more compressors, more facilities, and drill up and drill to fill those facilities. So there's an optimism that between now and the end of the decade, it's going to grow. On the oil side, the TMX helps out to bring heavy oil to the West Coast. And of course, demand will continue down into the U.S. Gulf Coast. But there's no real growth phase after TMX. So it's just going to be replacing decline rates. And of course, you don't really have decline rates in the oil sand, but on the SAGD you do, and in conventional E&P you do. So that's where you're going to see the growth, and that's where we're focused. Names like In Play and Bonterra, we've talked about them in the past, which are normal drillers, Rubelite. They're going to be seeing Yangara, they're going to be seeing growth from the drill bit.
When you're looking at these growth companies, then, what are the metrics you look at, first and foremost, in terms of current production, financial health on that front, and then the allocation of money that they are putting towards growth rather than returning to shareholders?
Well, you want that mix. So the first thing you want is a strong balance sheet. So you want the companies to have under the debt to cash flow or debt to EBITDA under 1 time, so that if there's a problem in the banking system, they don't pull the loans, which we saw in 2014, 2016, and we lost a number of companies that couldn't pay their bills and they went into bankruptcy. We don't want to see that. Second, we want large insider ownership. We want them thinking of as owners so that they want to see growth in the company so that they, of course, become wealthier from their shareholdings. So that's important. And then we want to see that they have a lot of inventory between inventory that's booked, inventory that's not booked, so that there are significant growth opportunities over the next number of years so that they can meet the growth of the targets that they talk about if the commodity price rises sufficiently to incentivize them to increase their drill profile.
Do you see much growth coming from acquisitions, M&A activity for any of these mid-tier, smaller companies outside of some of the major deals that we've seen?
Well, you're seeing a lot of companies focusing on the Montney and the Duvernay, and if they have non-core asset in Saskatchewan or West 4 in Alberta, you're seeing a number of companies put assets up for sale, and we've seen buyers come in who like those southeastern Alberta, southeastern and southwestern Saskatchewan, and deals are being done. And there's a lot of private companies where they're frustrated. The banks aren't supporting them, so they may be sellers. So I still believe there's M&A to be done. I'm not sure there's going to be a lot of M&A on the big side. I gather there's one big package out there right now. I'm not sure whose it is, but they could be at 200,000 BOEs a day. Once that is digested, then I don't see much on the big boys. I think it's one of the big American companies wanting to sell out. And so once that's digested, then we'll see how we move from there. I think the packages that we'll be looking at will be in the 10 to 30,000 BOEs a day, or the small privates, which are under 5,000 BOEs a day. And so again, trading below PDP in many cases, proved developed producing. So the buyers can say, okay, do I have drilling opportunities to grow this production? Do they have facilities? What are their liabilities, and are they manageable, or have they taken good care of them? So there's a lot of things that the checklists have to have for companies to make the decision that they're going to go forward with M&A.
So what about the natural gas stocks? And it sounds like you are probably more focused on the natural gas stocks in the U.S. since they're getting a better price for their product outside of what the Canadian companies are getting.
Well, we only cover Canadian domestic companies from the point of view of the NI 5101, all the regulatory, all the reporting, the accounting. Also, being in Calgary, I have access to management, which is a very valuable thing to be able to be updated on a regular basis. The only Canadian company I cover that does work in the States is a company called Southern Energy, which is working in Mississippi. They have a number of wells that they drilled, but they haven't completed, and they need to see sustainable prices over US $3 an MCF. And we're right now in the 280. So we need to see a hot summer, air conditioning demand strong, the LNG demand pick up. And if we see sustainable prices in the threes, they will be able to increase their volume, significant increase in cash flow, and that would be a positive for them. Outside of that, the U.S. price goes up, and if we get $4 U.S., then a year from now, we might see $4 Canadian. So that's a good bump from today. But remember, the U.S., when you compare it to Canadian dollars, 1.38, the Canadian industry is not doing as well as the U.S. industry.
What about the mix, the companies with the mix of oil and natural gas production? Many of them do have this. How are you analyzing these companies? What mix do you like to see?
Again, I'd like to see a growth profile on the oil. If there's no growth profile on the oil, that's problematic. And on the natural gas side, you want to see significant growth, and that they've done hedging to their business during the low price environment windows. And so you got to go into the detail. You got to look at the quarterly reports. You got to listen to the presentations on the webcast. So it's a hands-on job. And so our subscribers want me to do that for them. And that's why we've successfully grown our subscriber base, is because we cover all the different groups between the conservative pipeline infrastructure royalty, large cap E&P, small, medium cap E&P, energy service, and then international Canadian companies working internationally. So we try to provide ideas in each of those groups to our subscribers. And then, of course, we in conjunction with that, we have our Catch the Energy conference that you've been at in October, this year, October 19th at Mount Royal University in Calgary. We're 45 companies to present, 35 of them from my side. And the TMX, which is our major sponsor, brings 10 companies from the renewable world, critical minerals, clean tech. So if people are interested in the conventional industry of the energy industry of today and the energy industry of tomorrow, coming to that conference is something beneficial. And if you are a subscriber, you become a subscriber, we include 2 complimentary tickets. So that really is a significant added benefit to people to become subscribers.
Hey, I've been to that conference many years, Joseph, and I really do appreciate just how efficient that conference is and the time you get with these management teams, as well as the presentation slots that are longer than most other conferences I've been to. Final question on the stocks, then. When it comes to dividend, there any companies out there that really have your eye that are paying a much higher dividend than the average of the market that you also think is sustainable?
That's really an issue where you've got to know that they have a strong balance sheet. They have the production that generates the cash flow, but some of them are pretty high. And if they need to have hedging to make things work for them, I'll just go through just some of the yields out there. For example, you've got Alvo Petro, which is in Brazil with a 10.2% dividend yield. which is natural gas focused, Petrus, which is more natural gas, 9.1% yield. You've got companies like Whitecap that bought XTO, 7.3% yield. You've got Birchcliff with a 6.7% yield, which is a natural gas stock. So it really requires people to do their homework, decide what risk profile they want, how liquid they want the name to be. But I think that in the next few years, if the price of the commodity in both oil and natural gas go up, many of these companies will first repair the balance sheet. Then they'll be looking at return to shareholders. Some companies like to do more NCIB, like NuVista. Others like to do dividends and share buybacks. And others just prefer, because the ownership inside is very high, to pay dividends like a Pine Cliff. So each one is different, and that's why the due diligence and the homework is important. And that's why we created the product that we have.
All right, Josef, always great chatting with you. Thank you very much for your time. In the show notes, I will post that link to your conference. Again, happening October 19th in Calgary. I'll be there again this year. And for all of you in the area or want to travel to Calgary to meet with a lot of these companies, I highly recommend it. Please email me if you're going to, and I am happy to walk around that conference with you on site and talk to some of the CEOs and management teams. Josef, thank you very much for your time, everyone. Thanks for tuning into this weekend show. As always, please go back through the website, podcast, and YouTube page. Search the KE Report on social media. That's where you will find all of our content. I hope you all have a great rest of your weekend. We'll be back with you full time next week. Josef, again, thanks for your time today.
Super.